Welcome, future tax pros. Today, we dive into India's GST framework. Imagine a tax system simplifying transactions. Picture a unified path for goods and services. No more layers of taxes, just one clear structure. This system, my friends, is the GST. It's the game changer in India's economic landscape. For you, budding scholars, understanding this framework is key to navigating the world of business and law. Ready to unravel the mysteries of taxation? Let's explore together. What is GST? The Goods and Services Tax, or GST, revolutionized India's tax landscape on July 1, 2017. It streamlined the taxation system by replacing multiple overlapping taxes with a single, destination-based levy on goods and services. This shift aimed to simplify compliance for businesses and reduce the tax burden by eliminating tax cascading. Key benefits include eradicating the cascading effect of taxes, fostering a transparent tax structure, facilitating interstate trade, and broadening the tax base. In essence, GST embodies the vision of one nation, one tax, promoting economic unity and efficiency in India's indirect tax regime. Before the introduction of GST, India navigated a complex tax landscape with multiple layers of indirect taxes. The central government imposed levies like central excise duty, service tax, and customs duty, while state governments added their own taxes such as VAT, entry tax, luxury tax, and entertainment tax. This system led to a cascading effect, where taxes were piled on top of each other, inflating prices of goods and services. Businesses grappled with compliance hurdles, managing multiple registrations, and filing returns across various jurisdictions. The transition to GST aimed to streamline this convoluted system. Takeaway: GST aimed to simplify India's tax structure and eliminate the cascading tax effect. Ever wondered how GST operates in India? In Chapter 2, we delve into the three-tier GST structure. CGST, collected by the central government on intrastate supplies. SGST, collected by state governments on intrastate supplies. IGST, handled by the central government on interstate supplies and imports. Each tier plays a crucial role in tax collection and distribution between central and state authorities. This framework ensures a smooth flow of funds while maintaining clarity and efficiency in the tax system. Intrastate transactions, CGST and SGST work hand in hand within the same state. When goods or services are supplied locally, both taxes are levied equally, with the total GST rate split between the center and state. For instance, in an 18% GST scenario, 9% each is allocated to CGST and SGST. This simultaneous charge ensures a fair distribution of tax revenue between the two levels of government. Consider a sale within Delhi for 10,000 Indian rupees at an 18% GST rate. 900 Indian rupees goes to both CGST and SGST, resulting in a total of 11,800 Indian rupees. This collaborative tax structure exemplifies the balanced fiscal relationship between the center and state in intrastate transactions. When goods or services cross state borders in India, the central government imposes integrated GST, IGST, to prevent revenue loss. The IGST rate mirrors the combined CGST and SGST rates. Here's how it works. First, the supplier charges IGST to the buyer. Next, the supplier pays the IGST to the central government. Finally, the CGST portion stays with the center, while the SGST portion is transferred to the destination state. This system streamlines interstate trade and ensures a fair revenue distribution process. Ever wondered how the three components of GST stack up against each other? The Central Goods and Services Tax, CGST, and State Goods and Services Tax, SGST, are levied by their respective authorities on intrastate transactions, contributing revenue to the center and state, respectively. In contrast, the Integrated Goods and Services Tax, IGST, overseen by the central government, applies to interstate transactions at a higher rate of 18%. What sets IGST apart is its unique ability to facilitate set-off against all three components, offering enhanced flexibility in tax credit utilization. So, while CGST and SGST operate within state boundaries, IGST bridges the gap, ensuring a seamless flow of credits. Remember, understanding these distinctions is crucial for navigating the intricate realm of GST seamlessly. In the realm of GST, the concept of supply reigns supreme, marking a pivotal departure from the complexities of the past. Under this regime, every exchange carries a tax implication, encompassing a wide array of transactions like sales, transfers, leases, and more. This expansive definition mirrors the evolving landscape of modern commerce, encapsulating a vast spectrum of business interactions. Supply under GST casts a wide net, unifying various economic activities under one comprehensive umbrella, streamlining the taxation process. Diving into the diverse world of supply under GST, we encounter four distinct categories. First up, we have taxable supply, where goods or services invite GST at standard rates like 5%, 12%, 18%, or 28%. Imagine selling electronic gadgets or offering consultancy services. Next, we step into exempt supply territory, where no GST is levied. Think fresh produce or educational services from recognized institutions. Then, we soar into zero-rated supply, involving exports or transactions with special economic zones. Picture exporting software services to an overseas client. Lastly, we touch upon non-GST supply, which includes alcoholic beverages for human consumption, beyond the GST realm. Think beer, wine, or spirits sales. In summary, these varied supply types under GST shape the tax landscape, influencing businesses and consumers alike. Ever wondered what truly constitutes the core of supply? It's more than just the exchange of goods and services, it's the tangible products or intangible services provided in return for payment or valuable consideration. This crucial transaction occurs within the realm of business, intertwined with commercial activities, and is carried out by individuals registered or liable to register under GST. Supply isn't just a transaction, it's a fundamental element of business operations, connecting entities and driving economic activities forward. Remember, supply is not merely a transfer, it's the lifeblood of commerce, keeping the wheels of industry turning. In the world of GST, the taxable event is the supply. This key concept means that the obligation to pay taxes arises when goods or services are provided, regardless of the terminology used, be it a sale, transfer, or exchange. The crucial moment of taxation is determined by the time of supply, which hinges on factors such as invoicing, payment receipt, or goods/services delivery. The triggers for this taxable event include issuing an invoice, receiving payment, delivering goods, providing services, or whichever of these occurs first. Understanding this timeline is vital for knowing when to apply GST, issue invoices, and report to tax authorities. Imagine dining at a restaurant in Mumbai, where your food bill totals 1,000 Indian rupees. With a 5% GST charge, the calculation adds up. CGST at 2.5% is 25 Indian rupees, as is SGST. So, your total bill comes to 1,050 Indian rupees. In this scenario, within Maharashtra, both CGST and SGST apply equally. The restaurant, as a taxable entity, collects 25 Indian rupees for both the central and state governments. This transaction signifies the provision of restaurant services. So, next time you're out to eat, remember the breakdown of taxes on your bill. Ever wondered how taxes work in online purchases across states? Picture this, you order a 20,000 Indian rupee smartphone from Bangalore, but you're in Delhi. With an 18% IGST, the total bill comes to 23,600 Indian rupees. In this interstate transaction, the seller collects IGST and forwards it to the central government. Later, 9% of the SGST is transferred to Delhi. It's a seamless process of tax distribution based on where the product is consumed. So, next time you click buy, remember the intricate journey of your purchase from one state to another. In the dynamic world of freelance services, let's dive into a real-world example from Pune. Imagine a graphic designer charging 50,000 Indian rupees for a logo design. When we factor in the 18% GST, split as CGST and SGST at 9% each, the total invoice comes to 59,000 Indian rupees. This intrastate transaction in Maharashtra highlights the clear application of CGST and SGST. The taxable event here is the creative service provided, with the consideration being the agreed fee of 50,000 Indian rupees. This simple scenario unveils the intricate layers of taxation in service transactions. Remember, every creative service rendered is not just about the artistry but also about the tax implications it carries. In the intricate web of the goods and services tax (GST) system lies a vital component, the input tax credit mechanism. This ingenious feature empowers businesses to reclaim the GST paid on inputs, offsetting their liability on outputs. Picture this: a manufacturer acquires raw materials, pays GST, adds value, and sells the product. By claiming input tax credit, they only pay tax on the value they've added. This cycle continues down the supply chain, ensuring tax is levied solely on incremental value. The result? A streamlined process where tax cascades no more. Takeaway: input tax credit untangles the tax web, fostering a fair and efficient system. Ever wondered how goods and services are taxed in India? The GST rates range from 0% for essentials like fresh produce and educational services to 28% for luxury items such as automobiles and aerated drinks. This multi-tier system strikes a balance, ensuring affordability for necessities while generating revenue from indulgences. With most transactions falling under the 18% slab, the government aims to foster a sustainable economy. So, next time you reach for your toothpaste or consider a luxury purchase, remember the diverse tax landscape that shapes consumer choices. Who needs to register under GST? If your business's annual turnover exceeds 40 Indian rupees lakhs, or 20 Indian rupees lakhs for special category states, registration is a must. Engaging in interstate taxable supplies? Registration is required, irrespective of turnover. E-commerce operators and specific business types like casual taxable persons, non-resident taxable persons, input service distributors, and TDS deductors also need to register. Upon registration, you receive a unique GSTIN for invoicing and return filing. Compliance is key for seamless operations in the GST framework. And remember, registration under GST provides a unique GSTIN for your business, ensuring smooth invoicing and return processes. Are you keeping up with the GST compliance requirements? Registered taxpayers, listen up: monthly returns like GSTR1 and GSTR3B are a must, along with the annual GSTR9. Remember, every supply needs a proper tax invoice with essential details. Record keeping is key: maintain transaction records for at least 6 years. And the deadline for tax deposits? 20th of the following month, done online. Stay compliant, stay on track. Ever wondered how GST revenue flows? It's simple: where goods or services are consumed, that's where the tax money goes. The GST framework operates on 3 key components: CGST, SGST, and IGST, ensuring smooth taxation within and across states. Remember, every supply incurs GST, preventing tax cascading through input tax credit. And with multiple rate slabs, ranging from 0% to 28%, goods and services are taxed based on necessity and luxury. In essence, GST ensures fair taxation based on consumption, promoting economic growth and efficiency. As we delve into the practical aspects of GST, we uncover its transformative impact on India's tax landscape. This comprehensive system not only streamlines compliance but also fosters a unified national market. For aspiring business professionals, grasping these fundamentals is key to managing tax responsibilities, making strategic pricing choices, and ensuring legal adherence. Remember, GST transcends mere taxation; it's a holistic framework that promotes business ease, combats tax evasion through digital oversight, and ensures equitable revenue sharing between the center and states. Embrace concepts like supply, taxable events, and the 3-tier structure as the bedrock of all GST transactions. GST, One Tax, One Nation, unifying India into a seamless marketplace with enhanced credit flow and improved fiscal federalism. Explore further through practical examples, case studies, and staying abreast of amendments to deepen your understanding of this dynamic tax system.